Thank you on behalf of the team at Danos Associates and myself, and thank you for joining our fourth webinar event. I hope you've all, those of you who availed of our cream teas, I hope you've all enjoyed them sufficiently this afternoon. Today, we're going to be looking at the challenges of building a robust regulatory framework within the payments and cryptocurrency space. For those of you who don't know me, my name is Denis Spearman, and I lead the EMEA compliance and financial crime practice at Danos Associates. I'm one of the partners. I've spent almost 16 years focused on compliance and financial crime recruitment. In the last 4 years, worked extensively within the crypto and payment space, supporting our clients, with the build out of their compliance and AML programs globally. In the last 4 years, we've seen, as a business, we've seen a dramatic increase within both the cryptocurrency and payment space. Sheer number of new organizations entering the market looking to build robust regulatory programs has been staggering. We've been able to support our clients right from the early stages of getting them through regulatory authorizations, through to compliance and AML, business as usual, BAU, and onto, sadly in some cases, remediation support. So the full life cycle of a regulatory firm. Today, we're going to be hearing from our three panelists, Aamir, Tom, and Alison. They're going to give some insight into what they've learned through their careers about building a robust regulatory framework within this highly contentious space. We will have some time for questions at the end of the chat. So if you've got any particular questions you'd like to ask, please avail of the chat panel on the right-hand side to ask the questions. And we'll try and get through as many as we possibly can. Hopefully, the speakers will keep their allotted 10 minutes, and we'll get time for some questions at the end. If not, feel free to drop me an email, and we can forward them on. Finally, to our panelists, as I said, my stopwatch is running, so I will try and keep you as much as possible to your sort of 8 to 10 minutes. I'll give you a quick heads up when we're about 2 minutes from the end, and then I'll start to shout at you if you go over your 10 minutes too much. First off, we'll hear from our first panelist, Aamir Hanif. Aamir, please do give us a quick overview of yourself, and Aamir's going to be talking about regulatory control from a payments perspective, with a view to the two main bodies that have an impact on AML compliance. Over to you, Aamir. Thank you.
Thanks, Dennis. Hello, everyone. Thank you for inviting me to this session. I will share my screen and I've made a slide presentation. So my name is Aamir Hanif. I'm the Money Laundering Reporting Officer for the United Kingdom for Stripe. And I also oversee Stripe's Europe, Middle East, and Africa financial crimes function. I've been with Stripe since January of last year. Seems a long time ago, given these COVID days. Prior to joining Stripe, I was based in Bahrain, and before then in Singapore with Standard Chartered Bank, running regional financial crimes programs in some very low-risk jurisdictions like Iraq, Bahrain, Oman, Qatar, etc., in the Middle East, and then in Singapore and all of the ASEAN and South Asia region from Singapore. And prior to that, I was based in the United States, where I worked for the US government in Washington, DC, both in the US Department of Commerce's International Trade Administration and the US Department of Defense, focusing on trade agreements, financial crimes in Middle East and South Asia, and our trade agreements in, all over the world, really. So when Dennis asked me to talk about the topics that he's discussed, what I wanted to do was I wanted to split this into two categories. The first category is our regulators, and the second category is the partners, the financial partners. Regulators, as you know, are taking an increasingly growing interest in financial services firms and payment services companies, e-money license companies, etc. And there are a couple of reasons for that. I'm sure all of you have seen the news of what's been going on in new payment methods companies. And so the oversight of these companies has become more and more stringent. The UK regulator, Financial Conduct Authority, in April 2020, this is a year ago, came out with a Dear CEO letter that was focused on these new payment methods. They have just come out with a new Dear CEO letter 2 weeks ago, which is focused on retail banks. But if you take a look at that letter and you compare it to the one that was released a year ago, you will see that there are a number of commonalities in things that they want financial services firms to focus on. The reason I say that is to highlight the fact that from a regulatory perspective, there is very little difference between a fintech and a traditional financial institution. They're all being painted essentially with the same brush. So we all have to comply with the same requirements. The letter that came out last year highlighted a few things that for me, given that I had just entered the new payment method space, was very interesting. As every regulator says, firms should be alert to risk to facilitate, money laundering, fraud, terrorist financing, etc. But what they said was they reviewed hundreds of firms and they found several firms were failing to take appropriate steps to properly manage financial crime risks. And they highlighted specific issues: a lack of governance, lack of anti-money laundering risk assessment, customer risk assessments, lack of effective and risk-sensitive enhanced due diligence for high-risk customers, and senior management and firms not having adequate oversight of agents, particularly where these operate overseas. Now, all of our firms do cross-border business. And so it is really important for us to make sure that when we set up a financial crime framework that is best in class, it complies with not just our local regulators, for us, for me, it would be the FCA, but also our global regulators because of the businesses that we transact. And the fundamental start off for that is the risk assessment, right? Unless you know what your company's risk appetite is, what businesses you will support and what businesses you will not support, and within the businesses that you support, what will be the kind of due diligence you will do on those businesses, how can you stand in front of a regulator and defend your financial crimes program? And that is the thing that was highlighted here, which is the lack of risk assessments done by these firms. I will talk about the broader financial crime framework after my next slide, because the other side of, you could call it regulatory pressure, but it's indirect regulatory pressure that we see is from our financial partner firms. So what does that mean? Essentially, we have two kinds of financial partners. We have regulated financial partners and non-regulated financial partners. And within that space, you have these categories that I have listed here. Essentially, you have banks such as Citi, Standard Chartered, who are regulated and through whom unregulated banking companies do financial service transactions. You have credit card issuers and networks. We all know about them. I'm sure everybody has a Visa or MasterCard in their pocket. Those companies impose certain restrictions on us because they are our partners for credit card transactions. You have online shopping sites. Now, Amazon is not a financial services firm per se, but Amazon does a lot of business in the financial services sector. And if you are going to partner with Amazon, Amazon is going to come and impose certain restrictions on you. They may be specifically related to fraud and money laundering, less so in bribery and corruption. But when you develop your financial crimes framework, you need to make sure that those are included in your customer risk assessments. And then we have the new payment methods in the new payment method space. These would be firms like Klarna, BNPLs, buy now, pay later firms. And these firms, interestingly, are now also getting banking licenses. So you may know Klarna just got a banking license. So when Klarna comes and says, we want your financial crimes framework to include certain categories, certain restrictions, certain caveats, certain controls, they're coming at it from a banking services firm's perspective. The difference is risk appetite. So now that I've split this up, let me talk about the financial crime risk framework. So when you set up, or when we set a financial crime risk framework, we look at it from multiple categories, right? So we have the regulatory pressure, we have the pressure from our financial partners, and then we have our own pressure. What kind of business are we in and what is our risk appetite? And we start that off with the onboarding process. What are the controls we will implement? So we do a risk assessment, as was highlighted by the FCA letter. Then we categorize our merchants and our individual users into specific risk categories. And then we break that down into further into what kind of controls we will impose on them at onboarding and ongoing once we have given them a risk rating category. So once that is all done, essentially we have an understanding of who our users are and how we are making sure that we only onboard the good users and get rid of the bad users. And all of that is done by and with the controls that have been recommended to us, some as a mandatory recommendation and some as an optional recommendation by our financial services partner. So essentially, if I were to summarize my overview, it would be this graph with no words on it, which is essentially you have the regulator sitting over here, overseeing your financial services framework. Within the financial services framework, you have your payment services firm and all the controls that it has with all the different partners that it has. These are the conditions coming from them are noted here. So essentially what we have to do is make sure that our customer due diligence framework, our risk assessment process, our transaction monitoring and name screening processes all comply with both the regulatory frameworks that we are obliged to operate under and those imposed on us by financial partners.
Thank you, Aamir. That was really interesting and super informative. Speaking of Tom is going to discuss the importance of building a team of people with diverse backgrounds. Tom, please do give us a quick introduction and take us through your slides. Thank you.
So thank you very much for having me. So again, Tom Hook, I'm the U.S. Chief Compliance Officer at Bitstamp. I've been here for almost 2 months, coming up on about 7 weeks now. My background, I'm an attorney by trade, started out as a criminal prosecutor, and then entered the private sector to risk and compliance roles. So I've worked at large institutions like American Express, worked in consulting, Big Four consulting at KPMG, have worked in payments, technology, and worked previously in the crypto space at Circle Internet Financial Inc. And then joined Bitstamp to come back into the crypto space, which is a very, very exciting, very hot topic space. To give you just a little bit of background on Bitstamp, I find that folks don't generally know a ton about crypto companies. So we are the longest running exchange, around since 2011. Very regulatory and compliance forward organization, regulated out of Europe, regulated out of the US. We've got offices in Europe, US, Singapore. Are a cryptocurrency spot exchange. So, well, coming to Bitstamp myself, I think this presentation kind of ties very closely in with Aamir's as kind of a backup. Is I'm going to talk about how you build a team to support that regulatory framework that he discussed. How do you support those regulators? How do you support those banking partners? So, take that back. When I build a team, to me, that's kind of the fun part. You have to think about the fundamental information or the fundamental experience and backgrounds that you're looking for. I think it's important to have a variety of those. And so I'll kind of talk about these from a few different angles. So while I'm in the crypto space, I think it's important that at the base of your compliance program, as a central part of it, is that you have folks with traditional banking, traditional financial services experience. That provides a deep understanding of structure, of process, the importance of detailed documentation, and a real, eye into what regulators like. Traditional banking has gone through regulatory ringer, if you will, And so folks who've been in that space understand, I guess, what good looks like. I think to pair with that becomes very important to have folks who have experience in either the fintech world or, in a perfect world for me, in the crypto space, right? I think that brings with the folks who have that experience a different set of skills, a different set of things that they are familiar with. There's the understanding to move fast. This is a competitive, quick moving market, and we need to be able to move quickly with our partners to allow our business to adapt and move quick. The ability to understand outside the box problems and to solve those problems, right? Crypto is a complicated, nuanced space with a regulatory regime globally and within jurisdictions that is pretty complicated and fraught with gray areas and speed bumps that we need to be aware of. So I think it's important that you have folks with experience to be able to address those, be able to think of new ways to be compliant and meet the requirements while still embracing this kind of novel way to go about doing business and finance. Part of what ties into that as well is you have folks who are experienced working with product and business. I find that in my experience, when you work at a larger institute, you do close contact with the product team, the business teams, with the engineering teams. And I think within a smaller fintech or crypto business, you have compliance folks who've worked very closely on that. And then from a US perspective, at least, they have been through a heavy exam schedule. In the US, we are regulated by the states in which we do business, which means you can have up to 50 examiners. So you need to have folks who are comfortable under pressure, going through exams pretty continuous while still doing their BAU work. And then, to top it all off, it's the industry knowledge. And I don't think that necessarily means you have to have folks who've worked in the industry. I think it does mean you can have folks who are just crypto fanatics, folks who trade, who are involved in the industry while still working in a different capacity. I have had folks on my teams in the past who had no crypto business experience, but had all of their personal experience in crypto that really helped shape and form them as great assets. And then I guess the perfect world is if you get someone with a mix of it all. Another background, which is hard to find, right? Which is why I think if you can't find people who have the full experience, you pair them together, because ultimately what you will find is they will grow one another into these wonderful team members who can kind of cross boundaries. And I think the other piece to add in there that I don't have listed on the slide is consultants. I do find that consultants, maybe I'm partial, I've been one myself. I think that consulting can sometimes be like dog years. You have folks who have been through so many different experiences, so many different institutions, that they're able to adapt, to move quick. They have a lot of different lenses to see things through. And so that's another good kind of experience and background that I like to have in those teams. So kind of the next piece that I think is that team, when you pull together that experience, what are they doing? I'm going to talk about two pieces, two different angles there. One is a team of ambassadors. And what I mean by that is they are ambassadors to the industry, but from a compliance standpoint, they're more importantly ambassadors to your financial partners, your banking partners, and to the regulators, especially in crypto, which is a very unique, highly evolved and specialized space. You may be dealing with financial partners, banking partners, or regulators who are less experienced, knowledgeable of the nuances, the detailed nuances. All of these institutions are going to have their experts in the spaces and have some really, really smart people with the experience in, say, crypto. But not everyone you're dealing with will have that same level of expertise. So it becomes very important for your compliance people to be able to bridge that gap for them. So from a banking partner perspective, it is often the compliance team who's doing the first meeting with a new potential partner. right? They are showing why a partner would want to partner with a crypto firm. Part of that reassurance that they're giving is the strength of the compliance program, which makes it important to have some of that experience I talked about before. Folks with traditional banking will speak the same language. They will be speaking in the same compliance terms that would be expected from a banking partner. And frankly, the same goes for a regulator. I think then having consultants, you have individuals who are used to dealing with multiple stakeholders, who during examinations are used to getting tough questions from their customers as a consultant and can respond to those appropriately. And so really that core team that I talked about in the first slide will grow and create relationships with your partners and your regulators to help them get comfortable with your business so that you can continue to do business with them down the road, or I guess from a regulatory standpoint, that you can just generally continue to do business. Very important. The next slide. So I think this is something that maybe gets overlooked, is building a team of translators. And so this is kind of where I'll end is you've now got folks who can have the experience in the industry, know the requirements, know how to handle those requirements in a high speed, changing environment. You have folks who can speak to your banking partners and your regulatory partners and translate that information. But you also need to think internally. A big thing, and I pointed to this, is you have our internal pressures, the business pressures that you need to support. And this is where a lot of those problems will come into play, because within a crypto company in particular, you're dealing with evolving regulatory requirements. That should be a given that you know those. That's your compliance team, right? But there's operational considerations, there's technological considerations, and there's business considerations. All of it needs to be kind of swirled together, and your compliance folks need to know how to create unique solutions to these. I'm not going to use that. I don't really like this expression, but there's a ton of different ways to skin a cat. I don't know why people are skinning cats. That's a whole different thing. But there's a lot of different ways to get from A to Z in a compliant manner. And that to me is the exciting part of this. That's the fun part of working with business and product and the operational teams, is how do I take those requirements? How do I distill those requirements from the regulators, from our partners? And how do I make the business work with those? And so that is where you have a team of translators who are working closely with product and engineering, and development, to figure out ways that satisfy your banking partners, satisfy the regulators, and work from a business perspective and from an operational perspective, ultimately giving you a compliant and competitive product at the end. So that's, I think that's ultimately what you get from building this diverse team.
Thank you, Sam. That was really, really informative, and actually resonated quite a lot with what on the recruitment side of things. When we've gone to meet, cryptocurrency firms who are maybe in their fledgling state, and they want all those three things you talked about right at the start, and they want to get it for as cheap as they possibly can. So it really resonated with me, which was quite interesting. So thank you for that. And finally, we have Alison, who is going to discuss the relationships the banks are having to develop with crypto and payments in relation to risk assessment controls and a sound risk management approach. So thank you, Alison. If you could introduce yourself and take us through it. Thank you.
Sure. Good afternoon, everyone. I have speaking notes, not slides, and I will be looking at my notes periodically because I've been editing as Aamir and Tom have been talking. So forgive me as I look up and I look down a few times during our discussion. First, let me introduce myself. I am an independent director of Sigma Ratings. Sigma Ratings is an AI-driven risk intelligence platform that is used by global organizations around the world to help fight financial crime and to manage counterparty risk. Prior to that, I was the global head of AML compliance for Citi, as well as the global head of AML and sanctions consulting at Deloitte. So I am one of those dog-ear people that Tom mentioned. Let me talk a little bit about today about what banks are looking for when they decide who to bank. And I'm going to talk about the payments industry separately from the crypto industry. Banks are, at the end of the day, commercial enterprises, and they're always looking for new customers, new markets, innovative products and services in order to stay competitive. They also have many factors to consider, many of which were discussed so far: legal, regulatory, capital, operational risk, among others. From a financial crime risk management perspective, banks have innovated, given all of these factors, as financial crime itself has evolved and shifted, and as intelligence from governments has increased and regulations have changed. So there's a lot of dynamism, if you will, around financial crime programs, and banks are pretty good at adapting to all of that. Banks are generally meeting the needs of the market and managing financial crime risk. So the payments business is no different, and banks have applied the lessons they've learned over time from correspondent banking, private banking, trade finance, et cetera, to the payments industry in recent years. And they have, in my words, layered their products and services from low risk products and services, such as corporate treasury-oriented ones, to another tranche of products and services that are a little bit higher risk, wholesale banking, cross-border services, and then the highest risk products and services banks can offer that are high volume, low value, consumer and merchant level services. And so they're accompanying and increasing financial crime risk management controls associated with each of those strata or sections. So, and banks can't pick and choose what payments offerings they're going to offer to a payments company. They can't say, well, we'll bank your B2B, but not your crowdfunding, or we'll bank your wealth management, but not your P2P. And so for those of you in the payments industry, as you're rapidly entering your own new markets, banks have to have generally developed controls that match the expectations and the risks of those strata of products and services to what you're offering. So, banks are prepared to innovate in the payments industry and accommodate that, all of those factors, the legal, the operational risk, financial crime risk, and so forth. So the payments industry is innovative by nature, and banks have partnered with them to build in the controls that are fast and frictionless. Ideally, the payments companies have designed that into their infrastructure, as we talked about, to support financial crime controls built into your products and services at the outset. And then, for those that do, banks can not only see the controls that you've built in, they can rely on them, and then they can create controls on the bank side, which leverage them. Partnerships between payment companies and their banks are key. So as Aamir outlined, the frameworks for financial crime programs are, which the payments companies have, are critical, and banks are evaluating them as regulators are evaluating them and so forth. But also critical and foundational are the data requirements that help make the transactions flow in a seamless, frictionless, high-speed way. We can't always anticipate what regulatory changes may come about. And so if we can see integrated, infrastructure-oriented controls, then we know that we can adapt and partnership can adapt. So what kind of infrastructure are we talking about? We're really talking about data. At the end of the day, we need data to be present on the payments company side and to be available on the bank side, and frankly, to flow with the transactions that support things like the travel rule, screening for sanctions, supporting beneficial ownership requirements, and others. And you all know what those are, and you know that we have to accommodate them too. So we should be focusing on that data and high quality data, availability of data in all the infrastructure that we build. So transparency is the rule of thumb. The more transparent and valid the data, the more the payments industry can ask of banks, and the easier it is for the banks to meet their needs. And of course, the easier it will be for all of us to adapt to changing criminal behavior and for banks to evolve to the changing needs of the payments industry. So, keep in mind, banks are always evaluating their own customers, and they are going to evaluate them against the risk assessment they have, just as Aamir said, payments companies have to have. And so that symbiotic relationship of the availability of data, the quality of the data, and the controls that are in place to have seamless, well-priced banking services that allow payments companies to work in the domestic and global setting is really, really important. So just ask the payments industry to continue to learn, innovate, and to build the data requirements into your products and services so they can seamlessly come across to the banking world. So the cryptocurrency industry, now to look at that side, is much more nascent with regard to financial crime risk management. And so the banking world is again adapting from the lessons learned from other industries in the past to it. So in addition to the financial crime programs, which each firm will have, and as Tom rightly discussed, we are also trying to figure out how to automate controls when we decide to bank cryptocurrency firms. And so if there's a focus on seamlessness, on straight-through processing, then the challenge will then be on the availability and the transparency of data. And so a bit of an anathema, of course, in the crypto space, right? And I'm sure that Tom and others are figuring out how to balance that desire for privacy and all of our financial crime fighting needs with transparency. So banks are looking for those controls in VASPs and other crypto businesses, and where they don't exist, they will need to build them on their side in order to achieve the products and services that they seek from the banks. Look, the great thing about blockchain is that all the data is visible. But if it can't be analyzed by the controls that we are all discussing, then it's useless. So companies such as Chain Analysis, CipherTrace, and others are doing yeoman's work, trying to bring true transparency to all of us. So again, remember, we're talking about things like the travel rule, sanction screening, beneficial ownership, and so forth. As banks have to meet their own regulatory requirements and their own risk management requirements, they have to find a way to do that with the crypto firms, with, again, layering the same types of control expectations for the strata of services that we're talking about. Less controls for those corporate treasury type services, much more controls when you're talking about the individual transactions that may need to be executed. And so I guess I would say that if you can figure out on the crypto side how you're going to prevent and detect bad actors, that will influence how banks will offer you services such as cross-border payments and exchanging with fiat currency. How you address sanctions screening, and how you address commingling in a wallet, and how you address mixing and other forms of internal transfers, netting, margin, repos, how transparent you can be in all the parties in the chain will influence how banks view your risk management controls and what other services that you may need that will influence the bank's regulatory and risk management calculus. So as I originally stated, banks are commercial enterprises at the end of the day, and they're always looking for new customers, new markets, and innovative products and services to stay competitive. Banks are technically very savvy. They're very advanced in their own ways. They understand the blockchain, and they understand how financial crime risks do evolve, and they change rapidly. Many banks will partner with cryptocurrency players to embrace that same commitment, the shared commitment that we have for legal, regulatory, capital, operational, the safety of the financial system, as they're determining how to offer products and services with sound financial crime risk management. It's a challenging situation, but this is not the first time we've worked with new industries. Won't be the last, and we'll figure it out.
Thank you, Alison. Thank you very much indeed. Really, really enlightening. We're going to move now to the Q&A section of the webinar, and we have some questions for the panelists. But please do feel free, if there's anyone who'd like to ask a question, just send it to the chat on the Zoom call. The first question is for, well, it's for the whole panel, but really I think probably towards Aamir and Tom more so. your careers both before your current firms obviously were a larger, Aamir obviously larger banking organization, and Tom from a consultancy perspective. Were you really surprised in the differences in approach to compliance and AML, or were you pleasantly surprised that there was, it was well established and going well?
Happy to jump in there. I think it's a balance of both. There is certainly a transition period that you go through, without a doubt. I would say it's not that the controls are not there, it's that they're different. They're maybe not how you expected them to look or organized in the way that you would expect them to be, but they're there. And so sometimes, what I've found, you're going in to kind of help put it more into a package that would be recognizable to, say, a banking partner or a regulator, and kind of that piece. But there is a comical transition period that I think probably everyone goes through. But it's a great journey to be on, without a doubt.
Yeah, I agree with Thomas. It definitely is a comical journey, and if you saw the mistakes I made when I first joined, you would think my career was a joke. The truth is that I joined a new payment methods company because what I thought incorrectly was that the risks they face are different. And I was completely wrong about that. They face the same risks that a financial institution like a bank faces or a cryptocurrency firm faces. The difference is, the pace at which they face those risks is very different from a traditional financial institution. How they mitigate that risk is absolutely, like Thomas said, very, very different. Now, there are controls that are developed in a new payment methods company that a traditional financial institution is thinking of developing, but because of the legacy of systems that they have, makes it very difficult for them to implement. And so the conversational differences between a Standard Chartered would have with a regulator versus what Stripe has with a regulator is, Standard Chartered will say, we have these controls we're developing, and we use the data that we have and they integrate with these systems, and this is how we mitigate the risk. Stripe says, this is what we do. And when someone says, well, what about your other systems? We're like, there are no other systems. We developed it from scratch, and here you go, they're ready to go. So, I'm a massive fan of companies like Bitstamp, because you take the controls that have been developed by new payment method companies and you put them in a cryptocurrency space, which is such a, Thomas can correct me, but the reputation is it is such a risky space. But what most people don't realize is that a lot of these firms have developed controls that traditional firms don't know about. And so it is our job as compliance leads to essentially communicate that to banks, to the regulators, and tell them that, look, we understand the risk. This is why we've developed these new controls. The difference is, and I'll end here, the difference is the risk appetite. The risk appetite of a new payment methods company is very different from that of the traditional financial services firm for the reasons that Thomas and Alison outlined. And the challenge for us coming from the institutions we came from, I'll just speak from the challenge for me from the institution I came from, is to adjust that risk appetite. That was the biggest challenge.
Great.
Just to piggyback on,
Please, Tom, go ahead.
I think specifically the point around the tools that they can be developed within these types of companies and payments, fintech. Every time I have been in an exam or with a banking partner and we have shown them what we have, there's always an oohing and ahhing of, you have that all in one place? And so it is, to Alison's point earlier, and Aamir just said the same thing. It is that educating of, we know the risks. We have actually a wealth more, we are able to kind of consolidate a lot of this stuff. So it is, becomes incumbent upon folks like us.
Great. And then a sort of follow-on question for that. Obviously, Binance has been in the news quite a lot in the last month or so over here in the UK. And what does the panel think? Is this the kind of the first of many such issues, or is it going to kind of be a shock and a wake up to the market for the future?
I'll take the first crack at it because it is the UK and I am literally standing in London. So first of all, I don't think it is a shock. The reason why I referenced the Dear CEO letter from last year was because of Binance, because that showed that the focus from the FCA was on these new payment method companies. So that's not the surprise. It's also, I don't think, a surprise, given what happened with Wirecard, that regulators in Europe and indeed the world are more focused on new payment method companies. What I don't know is whether it is an issue of communication or whether it is an issue of lack of implementation of the controls that are already developed, or whether it is an absolute absence of, we don't care what the risk is, we're going to move ahead with the business. And since I don't know the company, I can't answer those questions, but it's not a surprise that the focus has gone up and that it will continue to go up as we move forward.
This is Alison. I agree with everything that Aamir just said. I don't think that it was a shot across the bow that every payments company is now in danger of regulatory scrutiny. I think the scrutiny has always been there. I don't know the circumstances of finance. I think that as I said, the payments industry is more mature in this space than the crypto industry. And I think that it's just a matter of demonstrating that the controls are there and that, audits have been done and so forth.
Yeah, I'd echo on both of that. Not a surprise. The regulatory scrutiny has always been there. I think, what has started to probably change, I would say this year, and I'll give it an analogy. When I worked at my last crypto company, my parents kind of laughed at the fact that I was going into this industry. When I stepped back into it now, they asked how they could buy Bitcoin, right? And I think the difference there is the retail market has exploded more, which means the overall risk is now increasing, because more people who are maybe less knowledgeable about the space are getting involved. So I think the regulatory pressure has to go up with that to continue to protect consumers from that regard, which is good for the industry. I think the more it makes us, the more pressure it places, the more everyone will have their act together. And as an industry, we will all rise.
Great. Thank you, Tom. And I suppose again to the panel, just staying on the crypto theme, interested to get your thoughts on where you think the biggest crypto hubs will be in sort of 5 years' time if the regulatory scrutiny continues at such a pace as it is today.
So I think that's one of those ones I'm going to answer without an answer. I think there's a lot. I'm in the U.S. There's a lot of uncertainty, and I think a lot of stuff is coming. I would expect sooner rather than later. So it's gonna depend on what lens that comes down with. If it allows for the innovation to continue, I think it'll continue.
I'll try and skirt around the question as well. I don't think so. I think the question shouldn't be where will the hubs be, because, and Dennis, please correct me, but I think that presupposes that there are certain jurisdictions where the regulatory oversight will be weaker than others, right? Yeah. And I don't think that's the case. I think given, for example, the FATF travel rule and FATF focus from multilateral organizations on controls within each country and then putting them on gray lists, etc. Malta, for example, that just happened, right? Malta was known as the gaming capital. Now it's on the gray list. So now its controls are going to go up. So I don't think that's the thing. The thing is, where is the infrastructure that allows a cryptocurrency exchange firm to succeed? And I think the challenge is that, for example, the UK, as you know, is a hub for fintechs. There's like so many fintechs here, and that's because the infrastructure is here. It has nothing to do with regulatory oversight, because that's the same everywhere. So I think that's the question should be, where is the infrastructure? And I think the advantage is for countries like Singapore and for countries like Estonia, in that they're developing infrastructure specifically geared towards those firms, and that will help them.
Fantastic, thank you. Well, look, I think that has been super informative, and I think we're kind of running out of time today. So I really just want to say, on behalf of everyone at Danos Associates, thank you to our panel for taking the time to speak to us all today. It was really interesting and really kind of enlightening. I'd also just like to sort of say, you know, obviously for everyone listening in, you know, we are, you know, always interested in chatting to people about this kind of space. And if there's any further questions you have or anything you'd like to discuss with the panel from a compliance, from an AML perspective, you know, get in touch and we can introduce everyone. But I'd just like to say again, finally, thank you so much to Tom, Alison, and Aamir. Really appreciated that, and we'll say thank you and have a very good evening, everyone. Thanks.
Thank you.
Thanks, everybody.